All right. What should investors do about the Fed rate cuts and China's slowing economy, yet raging stock market has the world wondering? And would the bursting of the AI bubble, if it is a bubble, decimate the US economy and stock market? And finally, every parent's nightmare. TikTok is still not banned. We'll talk about all this plus three stock ideas on this week's Curia Investment Show. I'm joined by my friend Simon Erickson of Seven Investing and Eoin Treacy of Fuller Treacy Money. I've known both of these guys for years. Great guys, a lot of great ideas. And by the way, if you're liking what you're seeing so far, and it's only been a minute or so, please subscribe and please ask questions, or you can send us an email at info@curiafinancial.com. All right, first story is the Federal Reserve. There's a meeting today of the Federal Open Market Committee of 12 people. Jerome Powell is one of them. He's the leader. He has just one regular vote. Can a man have two masters, though, or maybe even three? Powell has been stuck between rising unemployment. Weekly jobless claims, for instance, are near a 3-year high, which would normally lead a central banker to lower interest rates. And on the other side, higher than desirable inflation, which would prompt a central banker to raise interest rates or at least keep them high. And on the Z axis, a US president who, at least semi frequently, calls him a moron. It's not easy to be Jerome Powell. My take on this, and I'll go to you guys in a second. Investing is a social science, and there's a difference between being smart and sounding smart. At a time like this, it's very easy to give the smart sounding answer. The knee jerk reaction is, guess what? Lower rates are good for small caps. Small stocks have typically a lot more borrowings than large companies, and so lower rates are good for them. Same thing for utilities. Same thing for financials. Lower rates generally mean a more steep yield curve, which is good for banks. And by the way, I'm jumping ahead and making the assumption that lower Fed fund rates automatically mean lower free market interest rates. And that's not necessarily true. The Fed fund rates is kind of a wonky little rate that banks charge each other on overnight loans on their deposits at the Fed. They have minimum amounts they have to keep, and they top up literally every day at this rate. So it's kind of a small contained rate that usually, but not always, trickles out into the overall economy. Anyway, low rates are supposed to be good for financials, for dividend stocks. But if you look at the empirical data, it's a lot more murky. It's not so clear that low rates are automatically good for dividend stocks, or that falling rates are good for dividend stocks. In theory, yes, absolutely. But the actual real life data is not so clear. That's because the market is anticipatory. We're talking about low rates now, but if you look at the CME FedWatch tool, there's a 95% chance of lower rates this month. Don't you think the market has anticipated that? What I am more worried about, though, is that a Fed cut is adding psychological fuel to a perhaps dangerous market fire. Let me read you a headline I read from Bloomberg today. A record number of investors think the S&P is overvalued and yet want to buy more. Fund managers, by the way, are most overweight equities in 7 months. Now, if this is not the definition of a dumb market, I don't know what is. Basically a gray or fool theory situation. The managers know stocks are overpriced, but yet they're buying more. Eoin, I went on a monologue there. What do you think?
I don't think that investors have a choice. And when the market is going up, the worst sin you can have is to underperform. So they have to buy.
From a career risk perspective, right?
100%. They have career risk. But it's not just career risk. They have a fiduciary responsibility to their investors. And they don't like to have the meeting at the end of the year saying, well, I was really cautious with your portfolio because I'm really looking after you, but we underperformed by 5%. So they would much prefer to have that meeting where they say, I was really cautious about your portfolio and we met the market expectation or we outperformed slightly. Because then your client is going to give you more money. So obviously, that is the major factor behind why you have to be long in a bull market. And this is still a bull market, and it is being led higher by the AI stocks. And those AI stocks are spending money hand over fist in a race to get general intelligence or artificial general intelligence. Now, that's a massive amount of money, and it is contributing to GDP growth. So that's, I think, a very significant factor in all of this, that you have a big bull trend, you have the necessity to be long, and that is helping the market to move higher. And the market has priced in the interest rate cut already. So it's not really about this one, it's about the next ones. Are we going to get more interest rate cuts? That's the primary, I think, question over the market right now.
So does today's cut change how you're investing?
No, not at all.
Simon, what do you think?
It's an interesting market, James. I'm not sure that the great market that we've been seeing for the last 3 years.
That phrase can apply to anything. I love it. It's such a polished video answer. Interesting market, but it's true. It is true. It's a very interesting market.
Marches farther northeast, right? Up and to the right on every chart you see of the S&P. The S&P was up 26% in 2023, 25% in 2024. It's now around 12, 13% here in 2025, right? We have just gotten so complacent. It's so easy, right? Just park your money in the S&P and everything's good and everyone can be happy, right, James? But there's an interesting point. I think Eoin just touched on it correctly, that it's not that everyone is just, spending a ton of money and, consumer discretionary is just going through the roof, just like the S&P marches higher. I think that most of this money that is being spent right now is actually going to AI compute. In fact, in terms of absolute dollars that contributed to GDP growth year over year, there was more money that went to AI compute and data centers than there did from consumer discretionary spending. So it's going to be interesting. Is lower rates going to, help us in this kind of consumer funk we're in? It's also got tariffs and other considerations in there as well. Or is it just going to be the bigger going to get even bigger? NVIDIA and Microsoft and Google are going to have even larger market caps as they continue to spend aggressively on the data center.
And let me just double click on something you said, Simon, because you said it quickly, but I think it's something the audience may want to pause and take in. More money went to AI compute than consumer discretionary. Is that what you said?
In terms of absolute dollars in the growth that went into the American GDP calculation year over year, more of that came from spending on AI compute and data centers than there did in absolute dollars from consumer spending. And that's largely, James, from Microsoft, Google, Amazon, and Meta, the hyperscalers we always talk about all the time, collectively expected to spend $364 billion in capital expenditures this year.
Wow. So on one hand, thank goodness for AI compute. It's propping up the economy. On the other hand, if we lose that leg of our stool, we're probably going to have some trouble. We can touch on this later in the show. I know we got a segment on AI and tech and valuations. It's the topic that keeps on giving, but that's pretty amazing. So let me ask either of you guys this. Maybe start with you, Eoin. So it sounds like you agree that the market is overvalued. But you feel, there's a need to go along to dance to the music, but maybe in 5 years, in 7 years, you're not as bullish. Doesn't that suggest or imply sort of a market timing element that at some point, you got to be smarter than the other guys as far as when to leave the party? Is that correct, that framework? And B, if so, how do you plan to be smarter than the other guys in terms of getting out before the crash or before just things don't go as well?
Well, I guess, yes, I am a market timer. And I've been doing that for the last 20 years. So on that front, I think that the market will tell you when things are starting to roll over. And the most important thing right now is that the market is still going up and there is no evidence of a top. So what we're really doing is climbing the proverbial wall of worry, that people are worried about this market. They're worried about that there's going to be a bubble, but that's not market topping activity. It's usually when we would be sitting here and everyone is celebrating the wonders of AI and telling us all about how much money they're making. That's usually when you start to worry about a top. It's when everyone's talking about it. That's not generally what you get at the top, because it tells you if people are worried, it means they're not long. If people are celebrating, it tells you that they already have a long position and they're benefiting from it. So I think we're still in a very strong bull trend. And if we do get more interest rate cuts from here, that is going to be like rocket fuel for speculation in the stock market.
Oh, and I think, I don't know if you've been in the U.S. long enough to know who MC Hammer is. If you in Ireland, if you've ever followed his music, but years ago at a previous like, I want to say it's
Pump up the jam.
2008. Yeah, he was big. Like 89 was when his first big album came out. I had that. It was like one of my first CD. CD was like a new thing then.
Can't touch this.
Can't touch
Was
this.
that his first
Exactly
album?
right.
Okay, you got it. Okay, yep.
Yeah. I probably still know the words to that song actually, and they're not hard to. They're hard to hear. It's kind of blurry. Anyway, I want to say it was 06 or 07. Sometime he became a partner in this cash for gold business, like these quasi pawn shops, and that was basically a sign of the top when someone, and God bless him, maybe he's a great guy. He was presumably not a sophisticated gold timer. When people get in, that's the sign of like that. Get into the party. That's probably a sign that it's going to end soon. So it sounds like you're looking for the equivalent, with due respect to MC Hammer, of the MC Hammer in the the U.S. stock market bubble. What are some more concrete signs of that? I mean, is it just the froth, the fact that nobody's complaining? I mean, how do you know exactly as a market timer? I'm just pressing you because this is kind of like the multi-trillion-dollar question that I think everybody watching is wondering about.
I think there's two things that I would be very keen on watching. One is when we start to see that these companies that are spending all this money slow down the spending, when they're not spending $364 billion a year, or when they're deciding, well, we've got enough of this and we're going to spend 200 billion next year. Well, if they're going to spend less, that's going to withdraw an awful lot of the capital expenditure that's going into the economy. So I would consider that to be a very significant sort of fundamental indicator. And I would also be very, very cautious if what we saw was a lot of enthusiasm in the media and the social media about the outlook for AI, but the stocks were not going up. That is usually the counterfactual, because usually sentiment will peak after the stock price. So we will always watch the prices relative to what's happening in terms of sentiment. And at the moment, at least, we're still seeing prices going up and sentiment improving. That's a bull market.
Yep. All right, let's segue to our next story. Speaking of bull market, the U.S. market might be up, 11% these days. The Chinese market, though, depending on whether you're looking at the Shanghai exchange or the Shenzhen exchange, is up almost 20% or 31% in Shenzhen. Yet, we've got weaker consumer spending in China. I'm just reading some of these headlines from Bloomberg. Soft exports, a property slump. The stock market apparently didn't get the memo that China's economy is not doing so well. Eoin, I know you're someone familiar with China, and I say this as someone who did cross-border business between the U.S. and China myself for about 10 years. So I do understand the market. They used to call it an immature market. That was the state media term because it sounds better than a dumb market, an immature market. It is coming along. It is getting more sophisticated. Has the market in China gotten ahead of itself? Who do you think is going to win out ultimately between the optimists in the stock market or the pessimistic real data that we seem to be seeing?
Well, the pessimistic real data is why the stock market's going up, because the stock market is betting that rates are going to come down, that stimulus is going to start coming through in China to address
so bad that
the
it will
problem
get good,
in the wider
basically.
market. Absolutely. But you have to also admit that in China, there are different aspects to the market, and one of them is political. And we worry about politics becoming part of the market in the USA, but politics is the market in China. And you cannot have a bull market without a real seal of approval from the government. So I would say that one of the biggest signals we've had is Jack Ma is back at Alibaba. And he got himself into trouble in 2020. And he very publicly criticized the financial regulators in China. And they very clearly demonstrated to him who's in charge. And they took away his shareholding. He went into basically house arrest. He was completely off of social media for 2 years. And now he is back on the campus of Alibaba in Hangzhou. He is talking about taking the reins back on the company and leading the charge in AI. So the fact that he has come full circle, that he now has this seal of approval from the government. I almost feel like that this is like Steve Jobs coming back to Apple. That he founded the company, he got pushed out in a boardroom mess, the stock cratered, they brought him back, or at least they bought back his company, and he turned Apple into the most valuable company in the world. I think that what we're seeing right now in China is the government turning around and saying, well, if we want to revitalize the economy, we need a strong capital market. And that is what is driving the bull trend now.
I guess I have two thoughts. First, it's an amazing story with Jack Ma, just writ large. He's an amazing human being. In China, he's almost a deity in the business class. Wouldn't the pessimist, Owen, say, yes, that happened, but that's more a marriage of convenience, meaning the ruling party there doesn't really like Jack Ma. They don't really like businesses having all this power. There's probably right today, if Tencent, if Alibaba, if those kind of Jingdong did not exist already, they would not be allowed to grow so big and powerful. But China's economy is on the rocks, or at least it's going down a little bit. And out of desperation, they said, all right, we don't really like this guy, but we need to kind of resurrect him to make it look like we're capital friendly, which fine, if they do it, they do it. But like, couldn't the door swing the other way pretty quickly too one day?
Yes, it absolutely could. That's why I think that China is a trader's market. It's not an investor's market. It's not the kind of market that you will just sit on, forget about, put in the shoebox and come back in 20 years. China goes through medium-term swings, and it's really low right now. I think we're in for at least a 2 to 3 year bull market, and wow. I would be more than willing to play that.
Simon, I saw a scary article or data point inside an article showing something about domination of publications in leading scientific journals. And like 15 years ago, it was almost all U.S. institutions that would dominate all the scientific journals: Harvard, MIT, Carnegie Mellon, Stanford. This year, I want to say it was just Harvard that made the list, and all the other ones were Chinese schools. Things have come a long way. Years ago, I was at a conference and some guy said he was reading a Chinese patent filing. He said, well, it sounds like my research. And it turns out it was just like a Xerox version of his U.S. patent that he'd gotten 5 years ago. But that's before. It seems like today China is really innovating. The Chinese government has made like hard sciences a huge priority. They don't much like the social sciences at all. That's kind of threatening to them. But the hard sciences are something they respect. Whereas in the U.S. now, I think 2/3 of researchers are considering leaving the country. If I read a recent or 60%, if I read a recent survey correctly, because they don't feel as welcomed here. And that's not just of Chinese origin. It's just anybody. What do you think as far as the investability, though, of some of these big Chinese tech firms? They got a lot of smart people. They work very hard. They're very ambitious. But I just knowing you, I don't think you'd touch them still. Is that right?
Wouldn't touch them still. And that's just a personal decision, just mostly from my ignorance of the country, kind of knowing that there's kind of some roadblocks and some of that I wouldn't want to mess with. It's a good point, though, James, that I mean, the pace of innovation in China really, really fast. It always has been, right? Certainly in the scientific fields, technology. Some of the most interesting ones, in the fields of quantum computing are actually being led by a lot of Chinese companies right now. So it's going to be worth paying attention to and respecting. But personally, I'm not investing in those companies.
Yeah, I still hold some. I have mixed feelings about that. You're sort of in bed with the government there. If you own stocks, at least any company of meaningful size will have a government representative, and that's just how it is. But business moves 4 times faster. Maybe it's 2 times faster these days in Asia. In China, you send someone a message at 11 o'clock, you get a response by 11:30. In the U.S., maybe you get a response if you ping them at 7 p.m. In the UK, and I've worked in all 3 continents, you ping someone at 5:01 p.m., you're hearing back the next day. It's a slower pace in Europe, and U.S. is in the middle, and in Asia, this is their time, and they're hungry.
And there are pockets too, James, that I think are China is improving the bureaucracy and the regulations that it used to have. It was kind of suffocating a lot of its innovation and its tech industries. I'm thinking about the biotech industry specifically and drug development. You go back just a decade or 2 decades, and China was not putting out drugs on par with the Western drug makers, or Western European drug makers in terms of cancer immunotherapy and the PD-1s and all of these things. But now an overhaul of the equivalent of China's FDA, which basically tried to remove a lot of those constricting and regulatory barriers, has gotten the pace of innovation much, much quicker there. That's one example of how China recognizes, yes, it wants to be competitive on the global stage, and it needs to change the way that it was doing things. It wants to get there.
We're working on a Curia biotech project in the background, and that brings to mind an interview that I did with somebody, a friend of mine, who former sell side analyst from China, but he's been living in the U.S. for a while. He said, James, you don't realize how much biotech innovation is actually iterative, dependent on computer models, on testing a whole bunch of things really quickly. And China is really good at that. It's not some guy in a sauna having a eureka moment. It's a lot of iteration over and over and over again. And that's the type of innovation China does very well. So you could argue the West now needs China for biotech innovation. We've got these big companies who need that IP to get sucked into their models. And so there's actually a threatened Trump executive order that has got the industry a bit worried. It would ban inward licensing of Chinese IP. And frankly, that could be bad for Americans who need these cancer treatments or whatever it is.
And one last point I wanted to make on this is that, when we're learning more about genomes, genomes are regional, right? Like the genome of people of Chinese descent might be very different than Western European descent. And there's different types of cancers that are more prevalent in China than the United States. So it's almost a regional phenomenon. You want to have innovation for Chinese immunotherapies and cancer treatments coming from that country as well.
Yep, absolutely. All right. So moving on to our next story. By the way, I just a random factoid on China before we move on. I just have a note here. Chinese trade with the U.S. dropped by 1/3 in August, but it increased by about 1/3 in August with Africa. So the trade war is certainly not good for U.S.-China trade, but China is pretty quickly finding buyers and maybe some sellers too elsewhere in the world. Maybe they don't need the U.S. as much as we think. So AI and tech stocks are our final story here. The U.S. market is at or near all-time highs, up 11% to 13% this year, depending on which index you're looking at. But in a weird way, most U.S. stocks aren't. This is a difference between all the participants in an average and an aggregate average. Imagine if a team of 7'5" basketball players goes to visit a preschool class. The average head of the room goes way up until the team leaves, and then it goes back down. So, Simon, is there a risk? We talked about the AI bubble bursting, and obviously in this analogy, the 7-foot-tall team is these AI companies or tech companies that have at least some AI exposure that are propping up the whole market. In a year, what is the probability that team has left the preschool and we're left with a bunch of, this is a weird analogy, I know.
I love it. No, I was good. How much I love this analogy. I'm going to start using that one. Can I use that? Have you patented that analogy? Okay.
I'd be honored.
That's a good one. Yeah, man. I mean, I just this is the beauty of being, individual investors and being able to pick, either individual companies or pockets of the market you want to invest in, because we have seen ad nauseum, we'll still continue to talk about it, what a proportion of the S&P, the top 10 constituents are accounting for right now, right? And typically, if we look back for the last 70 years or so, maybe back to the 1950s, we've gotten used to the top 10 constituents, the 10 largest companies in the S&P 500. In essence, the S&P 10 accounting between 15 and 20% of the weighted average index, right? Based on market cap, it's a weighted average of that. James, it's at 38% right now.
Wow.
I mean, it's just, has marched higher. We thought it was really high when it was at 27% 2 years ago. And now it's at 36%. And it's no surprise, there is no limit. That 7'5" basketball player that we call NVIDIA, we've removed the ceiling on him. He can be 10 feet tall next year and then 15 feet tall the year after that, as there's just this flood of money that goes into, buying GPUs and AI computing. But at some point, you've got to quantify this $264 billion of CapEx that the big guys are spending. And I think it's going to have to come back to the American consumer. I think that right now, the American consumer is in kind of a funk for all the reasons that we've discussed. There's tariffs out there. Consumer spending is a little bit down. We've seen the reports from Chipotle, from Nike, from Crocs, from Lululemon, or whoever it might be, saying, yes, it's a tough time for consumer confidence. Oh, and by the way, there's more and more money being spent in AI and the data centers and the servers and the power supplies and the networking cards. All of that isn't the consumer spending money. At some point, Amazon, who runs an e-commerce platform, and Microsoft, who sells enterprise software to full-time employees, and Google, who does digital advertising for conversion of business, all of this has to come back to the consumer spending more money. And it can't just be that we just keep spending more and more money on AI without the economy being on stronger ground right now. So it's an interesting 1-2 going on there right now, James. I think if I was a betting man and I was going to bet on pockets of the market, I think I would bet on consumer discretionary, which is very out of favor right now as companies are struggling to hit their expectations and even show positive same-store sales growth. I would bet that's going to be a little bit more I'd be a little bit more optimistic on that in 2026 than I am here today. And maybe I think that we're even going to see a little bit of a slowdown in AI spending unless OpenAI can find a better use case than just displacing American workers with AI agents to do their jobs.
One thing I've learned in this world is don't underestimate the power or the propensity of the American person to spend money. I was looking at some data, and consumer spending rose in August for the third month in a row, at a time when unemployment is rising, at a time when consumer confidence is down, at a time when we've got a lot of bearish signals about the economy. American consumers didn't get the memo, or they did, and they just don't care. Like it's just like a water bill. Like it's very inelastic, right? No matter what, you're going to get your water, or maybe elastic demand. Consumers just buy. At least they have been so far. So maybe that trend will continue. And but on the AI front, speaking of that, so Eoin, I want your thoughts on this too. I'd love your thoughts. AI has gotten a lot of great news, a lot of hype, and I'm not any kind of expert. I won't pretend to be one, but from what I've read, there are some arguments that the marginal gains now are flattening out. That these current language models, there are miracles. That they do great things instantly. They do average writing immediately. In my area, I do a lot of writing, and that's a small miracle. But they don't do really good writing yet. They just do average writing. They do it really, really quickly. What if we've kind of reached the point of diminishing returns, and there's kind of a stasis for a while? At what point do things start to fall apart, not just for these companies, but then for market sentiment? I mean, valuation, the multiples are still relatively high. We got a generally bullish investing populace. Wouldn't it just take like a few big negatives on the AI front to spook a whole market?
I'll tell you the number that I keep hearing is 2027. And that is when you have two things are going to happen. One is that all this money getting spent on new data centers, well, those data centers don't go up overnight. So it takes a couple of years to build them. It takes a couple of years to build the connections to the power plants, and it takes a couple of years to build the power plants. So we're not going to have an answer to that question until 2027. And then you have, the people inside Google, the people inside DeepMind talking about that they think that they will have artificial general intelligence by about 2027. So the way that I kind of think about this is, in a normal product cycle, you come up with your prototype, and then you find that there's demand for it, and then you scale production. What you're getting in artificial intelligence right now is that they have to scale computing power first, and then they'll find out whether it works or not. Now, that's a big bet. We're talking trillions of dollars. By the time these data centers get built, we're talking about a multi-trillion-dollar bet that artificial general intelligence is both possible and that they have done what is necessary to make it possible. We will know an answer to that when these big data centers fire up. That's what the market's pricing in. But if it doesn't work, it's going to create a problem of magnificent proportions for the economy, because the debt issue in the US right now, the size of the deficits that we're running, this volume of debt that has been taken on, it only works if GDP growth is really high. And the bet is that AI is going to deliver that growth and that productivity gain. So if it doesn't work, well, then the debt is going to become really problematic. And I think that that is the reason why gold is going up, that it is almost like a tale of two cities. On the one hand, you have AI, which is doing very well, but you have gold doing well at the same time because it's a hedge against maybe AI does not work.
I was going to ask, of all the people I know, you are the most knowledgeable about gold, though, and Fully Tracy Money. You've got an entire gold product, if I recall. It sounds like, just to borrow the biotech analogy, the U.S. market is like one big biotech stock in a weird way, right? A biotech stock, let's say your pre-drug approval, your drug is either going to get approved or it's and you're rich, or it's not going to, and everything falls apart, right? It's one or the other. It's a binary outcome. And so it sounds like the fact that these tech, AI all-star kind of companies are doing awesome, and gold is also doing awesome, is reflective of an investor base making that bet. Like, either, okay, things are going to go to the moon, or they're going to blow up really bad. And there's probably not much in the middle. You agree?
Yes, 100%.
So we have a few questions, guys, if you don't mind, from the audience. A Lulu Huang asks, are AI stocks too expensive for me to buy now, or is there still upside? Probably a lot of people have this question. Simon, what do you think?
I mean, the first question is, what is an AI stock? Are we talking about a pure play that is only...
There are very few pure play, right?
You know, I immediately think of a company like Palantir, which is really, has incorporated AI into its operational intelligence software, and it's just getting a wave of new customers. I don't remember the numbers right now, but the price to sales on this company is in the triple digits. It is very expensive. You almost have to have things go perfect for a pure play AI company like Palantir or even NVIDIA to make money on this investment. There's such expectations that are baked into these companies right now.
And if someone's not sure what a price of sales is, that's revenue, just revenue, not even profit, revenue compared to the market cap. If it's triple digits, that means that if the company didn't grow, admittedly, but also had no costs, it would take more than 100 years for you to get paid back your original investment in that business.
It reminds me of the summer of the SPACs. If anyone remembers 2021, this is when everybody was showing these hockey stick projections. Does anyone remember the SPACs, the special purpose acquisition? I mean, like, this was literally...
They were so hot for like 9 months, right?
You didn't have to have any revenues. You just had to show a hockey stick, and you go out there and you raise $5 billion. And, it was kind of these structures where, it wasn't traditional IPOs. You could kind of get away with a lot of things. It feels like that right now when OpenAI goes out there and says, yeah, we're going to pay Oracle $300 billion to provide the computing for our AI models. Oh, and by the way, we did $10 billion in revenue last year. 30 times our existing revenue. We're going to sign a deal for a future. I mean, like, that's some hockey stick stuff right there. Maybe that happens. Maybe an OpenAI actually achieves 10x revenue growth in the next 5 years like it's predicted to do. But man, there's a very, very small margin for error when you've already got that baked into these valuations. I'm very full circle to the question that was asked. I am very hesitant about investing in pure play AI companies right now.
Got it. And if you're hesitant, I mean, you know this better than anyone I know. Charlie, the crocodile, Charlie, I think you were on the last call too. So thanks for watching, Charlie. What do you say to an investor who really likes the China biotech investing thesis, but just can't get comfortable with the government, the exchange, or the transparency is the way to touch this thing with gloves on? Charlie sounds very articulate with how he constructs his sentences. I think it's a nuanced question, but for me, it's a simple answer, Charlie. I think if you're not comfortable with China, you just avoid it. There's no way around it. I think if you, Simon is obviously uncomfortable with China. I'm probably in the middle on this panel, and I think Eoin is probably a little more comfortable. It probably depends on your holding period. If the longer you hold in the U.S. and the West, we think you have a good company. The longer you hold, the more things go in your favor. In China, there's kind of a mentality of you hold for the minimum amount of time and then you get out because there's just more probability of something to go wrong. So, because that's how the world has traditionally worked in China, and maybe it's a little more stable these days. But Owen, do you have anything on top of what I said to Charlie the Crocodile?
Well, I would definitely look at the relative performance. If you're looking at Chinese biotech companies, then they have to do well. There's no point in thinking that you can just buy it and forget about it. You have to base your thesis on momentum. And I would say that China is a get rich quick market. That is how the investors there think. They want to be in, they want to do well, and then they want to sell. So if you're not buying biotech because it's doing well, there's no reason at all to own it.
And let me add one more point to Charlie's question that I should have thought of earlier. A lot of these Chinese biotechs are no longer Chinese biotechs. And what I mean, first of all, they almost all trade on Hong Kong. Hong Kong has opened their arms to unprofitable companies. A long time ago, you had to be making a profit to trade in China or in Hong Kong. And that's why a lot of these companies would list in the US, because we did accept unprofitable companies. And China was correctly skeptical because they didn't want scams. They said, hey, if you want to be public, you got to have like real profit for at least 3 years, something like that. They have rolled back those restrictions because they saw that they were losing too much IPO business, basically. So most of these companies are listing now in Hong Kong, and the Hong Kong Biotech Index is up like 100% year to date. They're not just listing in Hong Kong, though. They're moving their domiciles out of China, sometimes to not just Singapore, but to Switzerland and a couple of places. So if you wanted kind of the safe guys play on Chinese biotech, find one of these guys that's maybe started in China and employs a lot of these Chinese researchers, but is now headquartered in Switzerland. I'm not saying that's total safety, but it's probably a notch up from something on the A shares market. Okay, another quick question. If the Fed cuts rates, what's the single most important move I should consider with my money? That's a money shot, zinger of a question. Either of you guys have a thought on that?
The single most important thing to do with your money is to be invested, because the purchasing power of your currency is going down.
Yes. Yes. Totally agree. And I might add, if it sounds cheesy, but do nothing. I mean, besides being invested, when in doubt, don't take action. Okay, we have a strong activity bias as human beings, and we think something happens, I need to do something, I need to do something. And at least with my style of investing, which is more of a long-term style of investing, it's usually better not to do something if you're not sure. Now, maybe Owen, you may trade a little more frequently, and that may be bad advice for someone following that style. But at least if you're in the buy and hold camp, when you're not sure, it's better to underreact than to overreact. Another question from Charlie: how short of a time horizon would I need to be on for a rate cut to matter to me? Okay, that's interesting. So yeah, if you were not to be a long term buy and hold, do nothing kind of investor, what what would be an appropriate time horizon to take action with a rate cut? I would say if you're like within 6 months, then maybe it's something you can trade. But again, the market is anticipatory, and with a 95% chance leading into this Fed rate cut of a rate cut per surveys, like most of the obvious stuff is already priced in. So if you've got a trade idea, it better be something very, very clever. Otherwise, your profit margin is going to be pretty small. Owen, what would you, or Simon, what would you add to that?
The way I would look at it is that the 2-year yield is the best lead indicator for where the Fed funds rate is going to be. And that implies there are going to be 3 rate cuts at a minimum. So we have now priced in at least one, and we're on the way to pricing in more. So that, I think, is the most important factor. It's not about this rate cut. It is about the next rate cut. That is where the market is pricing now. Everything that we've talked about until now is already in the market. What we're talking about, right, is the future. The future is where more rate cuts occur.
So one more question, we'll wrap up with our stock ideas. Simon, this has got your name all over it. Tesla stock had a huge jump. Is this rally justified by fundamentals, or is the move momentum?
It's both. The momentum, certainly, because Elon Musk went back to work. He's actually reporting to the office at Tesla again, which everyone applauded on the momentum side of it. But also, James, they had a tough couple of quarters there. This is justified because Tesla's stock sold off because it wasn't selling any cars to Europe, based on a lot of things that were going on with the things that Elon had said and other things we won't get into here right now. But it was also stockpiling inventory in China. Those are both correcting a little bit from a fundamental perspective. The big question for Tesla, though, isn't how many cars is it going to sell. It's going to be, can it get this autonomous fleet actually to work? That is the driver of the stock price. If you're investing in Tesla, you have to bet on it building an autonomous network, kind of like an Uber, rather than just selling more Model 3s around the world.
My dad, Simon, was complaining yesterday that Tesla, I was driving him to the doctor, complaining that Tesla made a big mistake in avoiding LiDAR and going with cameras for their self-driving, because at the time, LiDAR was very expensive and the cameras were a lot cheaper. But now it's apparently clear that the cameras is the inferior technology. How big of a weight does that have in affecting Tesla's ambitions in this autonomous front?
This is really hard, James. I think that the thing that we need to point out here is that 96% is not good enough if you're doing full self-driving. That's going to be too much of a margin of error for accidents and fatalities and things that you just cannot release something like that. You can have autopilot, yes, you can have, but a fully, level 5 autonomous vehicle has to be perfect. And I rode in the original Waymo, LiDAR powered autonomous vehicles back when they still had to have a driver with his hands right outside of the steering wheel. It was scary. They were talking about they were the global leader in autonomy, and still I just felt uncomfortable, and it was almost just like being on a roller coaster almost in a vehicle. And even today, I think LiDAR has got its own limitations. I don't think that it's gonna be there. I think that you're going to continue to see these kind of subscription packages that Tesla's selling at $100 a month or whatever it is now. And then in terms of the full autonomous network, I still think we're probably at the end of the decade before we start seeing that ramping up. They've got to figure out the specifics of the vehicle and get it to a low enough price point anyway before we get there.
Gotcha. Wise words. What do you guys think? Just thumbs up, thumbs down. TikTok ban or TikTok non-ban are positive for you guys, not positive, both as parents and for just the U.S. Quicker answer on this one. No strong
I think
opinion.
It's positive for the U.S.
Pardon?
I think it's positive.
Positive.
China's not going to have control of the US version anymore, and social media is not going away.
Yeah, it's probably the jaded, realistic way to look at it. As a parent too, I'm not a fan of TikTok, but I wish the thing would go away. But it's probably not. So we'll take it. SEC potentially ending quarterly reporting because it's expensive and takes a lot of mental energy for companies. Is this a positive, negative, or neutral?
For me, it's a negative. I still like quarterly reporting. I mean, we do put, just our nature is to put everything under the microscope every quarter. Did they hit or did they miss the number of EPS? But I still think more transparency is generally good. I would like to see it continue, even if perhaps we get a little bit less hands-on and less under the microscope for every number that's reported.
Yep. So Simon, while I got you on, what is your stock idea that you're looking at? And for a disclaimer, these are not recommendations. Don't go run out and buy these. These are just interesting stocks that we're looking at and sharing with you.
Yeah, I think we did Duolingo last time we filmed here, James, if I remember correctly. And so I'll keep the AI trend going here. We're talking a lot about AI. And I'll go with Salesforce, CRM, the ticker on that one, trade on the NYSE. Of course, the cloud computing software as a service Jedi master that created this entire industry is now looking to agents to actually not just, put all of your information for your organization in the cloud, but then also start making sense of it and start acting autonomously on it. And so Agent Force is kind of the driving narrative right now. It's actually going out there and deploying agents in organizations. It's got 150,000 customers that are signed up out there. About 10% of them so far have been early adopters of this program. But that's not why I think Salesforce is an opportunity right now, James. I just think the bar is way too low on what the market is expecting Salesforce to do, right? By my numbers, even if it only grows its free cash flow at 9.5% annually for the next decade, the stock should have about 40 to 50% upside. I think it's worth $354 a share at a floor, at a minimum. And at $240 a share today, it's just completely undervalued. I don't think the market's giving this one enough credit. It's worth a second look.
CRM is the ticker there. Eoin.
I would look at Baidu. That is the biggest Chinese cloud provider. It's sort of like the Chinese Google.
It just popped recently, right?
That is going to be one of the. It has just popped. But coming off an exceptionally low level. So we've had at least a 3 to 4 year downtrend, and that looks like it's over. So I would say that is a very strong momentum play.
Baidu, and the ADR ticker in the US is what, BIDU? Is that it?
That's right.
Baidu. Okay, certainly spicy. I'm going to go with Diageo. The ticker in the US is DEO. In the UK, it's DGE. This is a stock I've known and loved for a long time when I used to run Motley Fool Income Investor Service because it's a good dividend yielding stock. It used to be 217 a couple of years ago per share in the US. Now it's 100. So it's taken a real beating. Millennials aren't drinking as much. They vape and they do whatever else, marijuana, which is worse, right? And GLP-1 agonist drugs have reduced cravings. However, I think the market might be overblowing this. Diageo is not like a bulk alcohol company. It's more of a status symbol, prestige alcohol company. And I think more than 40% of its sales come from emerging markets where it's considered cool to give someone a gift of booze. I know this from China. You give a gift of booze commonly in a business meeting. So Diageo's they're not Miller Lite. I mean, it's not something you would buy and drink every day. Or some of the things are, but in general, they have a lot of these premium, ultra premium, super duper premium. They've got these bizarre categories, but that's a stock that's beaten down that I still believe in. So if you watching like any of these stocks, you want to learn more, if you drop an email to info@curiafinancial.com, we'll have a PDF summary of this discussion. We can also give you last times if you want. Also, info@curiafinancial.com. We'll get you over a summary. Thanks, guys, for watching us at home. Eoin Treacy of Fuller Treacy Money, Simon Erickson of Seven Investing. Thanks to you both for being such great guests. And we'll see you next time on the Curia Investment Show.